people were familiar with me in face. They knew that we would be honest people. At least I looked honest at the time. And so we delivered.
I got to ask you about this zero commission thing you went to last week on equities and ETFs. It really rocks the world.
You might not realize it, but getting into dividend investing isn't as tough as it seems. Today, we're taking a look at the SCD, or the Schwab U.S. Dividend Equity ETF, known for its impressive returns and steady dividend growth.
We talk a lot about ETFs here. Schwab has muscled into the ETF space in the last 5 years. You're now number 5 from nowhere. It's really very
I don't
impressive.
know if we muscled in. We just offered great value. We had reduced the OERs down to something near zero, not quite zero. And people are attracted to it.
How do you feel?
And here's the kicker. With the power of the dividend snowball effect, you don't need to throw down a ton of cash to start living off dividends. This fund not only provides a simple, low-cost way to build your wealth, but it does so with surprising efficiency. Plus, stay tuned till the end of the video because we'll crunch the numbers to see just how much you need to invest to comfortably live off dividends. Trust me, the answer might just blow your mind. To understand how the SCD performs, it's crucial to grasp its concept and history. The Schwab U.S. Dividend Equity ETF offers a compelling blend of consistent dividend income and potential for capital growth, making it a top choice for conservative investors. Launched in October 2011 by Charles Schwab, this ETF aims to mirror the Dow Jones U.S. Dividend 100 Index. This focus reflects a strategy that emphasizes high dividend yields alongside sustainable financial practices. The ETF's investment approach revolves around a rigorous selection of criterion that prioritizes high-yielding stocks from financially robust companies with a reliable dividend payment history. This strategy ensures that the ETF comprises strong companies capable of maintaining payouts even in volatile markets. The philosophy of the ETF is particularly appealing to investors seeking both income and moderate growth in their investment portfolios. Over its history, the SCD has demonstrated impressive performance metrics. Since its inception, it has delivered an average annual return of over 13%, which stands out as the dividend-focused ETF market. In the past decade alone, the ETF has achieved a compound annual return of 11.62%, with a standard deviation of 14.51%. This performance is notable for its resilience during economic downturns and market volatility, often outperforming broader market indices. The ETF's focus on large-cap, financially stable companies contributes to this resilience. The historical data also reveals a consistent increase in dividend payouts, reflecting the growing profitability and cash flow stability of its constituent companies. This trend bodes well for the ETF's potential to sustain income distribution over time, making it a dependable choice for investors seeking regular income streams. Another significant advantage of SCD is its low expense ratio of 0.06%, making it one of the most cost-effective options in its category. This affordability directly benefits investors by maximizing the net returns on their investments, which adds to the appeal of SCD in a competitive market. The recent market performance of the Schwab U.S. Dividend Equity ETF further highlights its resilience and ongoing appeal to investors. As of the latest data, SCD manages a substantial asset base, totaling approximately $6.46 billion. This sizable asset base reflects the trust and confidence that investors across the spectrum place in the ETF, underscoring its reputation and perceived stability in the market. In terms of returns, SCD has recorded a year-to-date daily total return of 5.27%, a notable figure given the broader market context. This performance indicates that SCD has navigated recent market volatility better than many of its peers, a testament to its focused management and strategic asset allocation toward high-quality dividend-paying stocks. SCD offers a current yield of 3.31%, which is competitive within the category of dividend-focused ETFs. This yield is attractive to income-seeking investors, especially in an environment where interest rates on safer assets like government bonds remain relatively low. It reflects not only the dividend payments from the underlying stocks, but also the ETF's ability to maintain these payouts even in fluctuating market conditions. With its strong yield, solid returns, and substantial asset management, SCD maintains its position as a leading ETF in the dividend space. It continues to draw investors seeking a balance of income generation and potential for moderate capital appreciation, making it a preferred choice for long-term investment strategies. These factors highlight why SCD remains a significant player in the investment landscape, especially for those prioritizing income alongside growth. Its performance, particularly in terms of yield and total return, places it favorably within the competitive ETF market, providing a promising option for both existing and prospective investors. Let's delve into understanding the dividend snowball effect and how it can make a difference in reducing the initial investment required. Have you ever watched a snowball grow as it rolls down a hill, gathering more snow and gaining momentum? That's a perfect metaphor for the dividend snowball effect in investing. When you reinvest your dividends, you buy more shares of the stock or ETF, which in turn generate their own dividends. Over time, your income stream can grow significantly without any additional investment from your pocket. This compounding effect can be a powerful tool for long-term wealth creation, especially when utilizing a good dividend-paying ETF like SCD. SCD is particularly well-suited for this strategy due to its focus on companies with a solid history of paying dividends that grow over time. Investing in SCD means your portfolio isn't just static, it's dynamically increasing in value and yield, creating an ever-growing income stream. Here's how SCD enhances the snowball effect. Firstly, consistent dividend growth. SCD holds companies that have a strong record of growing their dividends year over year. This means the dividends you reinvest are likely to be larger each time, accelerating the growth of your investment. Secondly, stability and reliability. The ETF's constituents are companies with long histories of financial health and dividend reliability. This stability is essential when dealing with market volatility, ensuring that your dividends remain consistent. Let's break down a simple example to illustrate the potential of living off dividends. Suppose you start with an investment in SCD that generates an annual dividend yield of 3.31%. If you continually reinvest these dividends, the compounding effect kicks in over the years. As the dividends increase and you accumulate more shares, your annual income for dividends can grow to a sizable amount. Imagine this scenario. You start with $100,000 invested in SCD with an initial yield of 3.31%. Your first year's dividends are approximately $3,310. Reinvesting these dividends buys more shares, which themselves will generate more dividends the following year. Assuming the dividend growth rate and yield remain consistent and factoring in the average total return of the ETF, your dividend income can potentially double every 7 years. This isn't just a theory, it's a practical, achievable result that many investors strive for. The dividend snowball effect is not just a theoretical concept, but a practical strategy that can lead to real financial independence. By choosing a vehicle like SCD with its solid dividend growth and low expenses, you can set up a foundation that can support you in the future. Now, consider your financial goals. How could starting this strategy today help you build towards financial freedom? Think about it, and maybe take that first step towards creating your own dividend snowball to achieve this. To do so, you must determine the amount and duration of investments necessary to support yourself solely on dividend income. So let's dive into figuring out exactly how much you'd need to invest monthly to comfortably live off dividends in 20 years, based on current financial figures and the performance of SCD. We'll use the average U.S. annual salary of $59,800 as our target income, which was the figure at the end of 2023. This helps us understand the investment required to match that salary solely through dividends. Firstly, we need to consider the impact of inflation, which erodes the purchasing power of money over time. With an annual inflation rate of 2%, the value of money decreases, meaning you'll need more in the future to maintain the same standard of living. So, in 20 years, that average salary of $59,800 would be equivalent to $88,200 in future dollars to have the same purchasing power as today. Now, let's crunch the numbers on how much you need to invest each month in SCD. Assuming an average annual return of 11.62% and a dividend yield of 3.31%, your investment will grow over time, generating income through dividends. If you reinvest all dividends and the total return remains consistent at 11.62%, you'd need to invest approximately $1,500 every month for the next 20 years to achieve an annual dividend income of $88,200. Imagine setting aside $1,500 every month, similar to a mortgage or car payment. This money goes into your investment, earning dividends that buy more shares, leading to even more dividends. It's like a financial snowball rolling downhill, growing bigger and faster over time. With this disciplined approach, you could potentially cover your annual living expenses without touching the principal. Starting small and patiently growing your investment over time can lead to substantial financial independence. By leveraging the power of the dividend snowball effect through SCD, you're setting up a sustainable, growing stream of income for the future. Think of it as building your financial freedom 1 month at a time. So why wait? Consider taking that step today to secure your future. If you have any insights to share with the community, please drop them in the comment section below. Thanks for watching, and we will see you in the next one. Your suggestions for future videos are always welcome in the comments below.